Thank you, everybody, for joining. Today, we have two special guests. We're going to talk about GIAX. And I want to let the guests introduce themselves, and we're going to go through the information that they have available for the fund.
Awesome. Well, Brett, great to be here. I have to say thank you because you were one of the first to actually mention GIAX. I don't know if I've mentioned that to you. This is the first time we're talking, but your videos have been great. And I mean, we got comments, calls, emails to the office for the first time you mentioned the fund. So big kudos. I need to send you a hat or something. So it's in the mail, but thank you for doing that.
No problem.
Yeah. But yeah, David Nicholas, portfolio manager of GIX, and about 20 years plus in wealth management. And this is our second fund that we've launched. This one's fun. We're excited to talk about it, and it's very unique. When we looked at the landscape, there's a lot of these covered call income funds for sure, and Brett, you do a great job talking about a lot of them, but generally they were US, they were single stocked, and there was very few. I didn't really see any that had an international exposure, and so it's one that I think is something where if you're looking to diversify the portfolio, it's very unique in that sense. So excited to get to talk about it today.
Yeah, I'm Jay Pestrochelli, CEO of Zega Financial. David and I, as you mentioned a minute ago, David, have multiple funds together. My shop usually handles the option side of the portfolios that we discuss. Zega Financial has always been an options-based shop, and we are the sub-advisor on GIX and portfolio manager along with David. So it's great to be here with David.
Great. Okay. We'll run through the pitch book here. So this is available on our website. If you go to nicholasx.com, right-hand corner, you can click on GIX, and then we've got the pitch book there. You can see, right, if you go to that next slide there, you'll see it says a diversified global approach to income. And I think that really defines the fund. And one of the things that, we have a lot of retail investors, Brad, that follow your channel, a lot of do-it-yourselfers that are investing, that are retiring, looking for income. And I think one of the challenges is how do you build a diversified portfolio? And you have to understand, I'm looking at it from the lens of really as an advisory practice. If a financial advisor is going to recommend a fund to a client, diversification is key. And so this is why we lead with diversification. And so if you're an individual investor, a retail investor, David, I don't need to hire a financial advisor. I want to create an income portfolio on my own. This really does give you where you have, institutional management, institutional money management, diversification, along with some income. So if we go to the next slide here, you can kind of see it's broken down into two components, right? You got the equity component, which is diversified ETFs. We primarily use Vanguard. One of the reasons I like Vanguard, obviously it's a big institution, but they're low cost. And so generally across the board, if you're looking at looking at a universe of funds, Vanguard is going to be about as good, if not better. And the cost is an area that we like from a total expense ratio standpoint. So the first component is going to be ETF. So you're buying an ETF, but then you also have ETFs in the fund that are diversified. So we'll look at ETFs that track an index, but then we'll also look to replicate the index, for example, the Mag 7. So we also have NASDAQ exposure, but we also we can own individual stocks as well, which again is really unique. So you're getting a mix of both diversified ETFs, index ETFs that can track US indices, international indices, but also individual names like the Mag 7. We also have some individual names from international companies as well that we like. Then you add the component, the overlay of the index call spread. And so this is where Jay and his team do a great job of identifying the index to run the spread on. Again, we work with them closely with Jay to make sure what index are we selling on, how far out of money do we want to be, but it's ultimately to hit that goal, right? Which right now the current distribution rate is about 24% per year, about 2% per month. So again, pretty simple. You got the ETF, the index component, and then you got the call spread component that's overlaid on the portfolio. So you can just see it's very simple, right? We have this visual here, ETFs plus the options overlay is what you get with GIX. Funny backstory to this, when our marketing team was trying to come up with, this whole idea is why choose between income and growth. A lot of great funds out there, but in some ways you either only get income, right? So it's pushing out a really good income, which is great, but you might get some NAV decay or you're getting a decline in the price of the fund. My whole goal with starting this fund is, look, I want my clients, our investors, they want income, no question, but they don't want to see their NAV eroded. And again, I get total return. I get if you're reinvesting dividends, and I understand all that, and there's a lot of math behind that. But in a perfect world, we would love to see steady to increasing NAV, no guarantee, while you're getting income. So I'm giving away our secrets here, Brad, but this is actually a Chat GPT generated image here of you can see the guy on the left, he's our old school income, and the guy on our right's our growth guy, right? The old school muscle guy is our growth. So silly, but it's just a visual that our marketing team kind of came up with to kind of get, look, we still want our income, but we got to get growth.
I was hoping that wasn't you and me, David, in the picture there that you were trying to make fun of, but there you go. You did a strong guy.
And you're exactly right. We're looking for, my whole goal is to live off of 8% of my portfolio.
Yeah.
So if you're paying 24% and I'm only taking 8, that leaves me 16.
Yeah.
Either to reinvest into the fund or to diversify into other income streams.
Correct. Yep. That's right. That's right. And again, and I love it's great to draw the whole yield down, but again, yeah, if you're only living off a portion of that yield, right, it either gives you get to build up cash and you can go into more conservative investments, you can buy back more shares, which the math on that really gets interesting if you're not taking the income to spend and you're reinvesting. So yeah, a lot of options there as well, which is good.
And that gets into another one. And this is just my philosophy is I don't buy back into the fund until it crosses the 50-day moving average. Not that I'm gaming the system. I'm just, why reinvest when it's at the peak?
Yeah. Yeah.
Right? So I'm looking for that correction. I'm looking for that. I'm looking for a dip.
Yeah.
And I have a little cash on the side, and that's when I'll buy, and you guys will recover from the dip because, either through the index, trades or through that underlying going up. That's and right. my philosophy is the markets go up and to the right over time.
Yeah. Yeah. Yeah, that's right. That's right. And I think you've said it. Yeah, you're not afraid of a dip, right? You get to buy back more shares. So I totally get that. So Jay, I don't know if you want to just talk a little bit about the spreads and kind of how we structure those to hit that target income.
Yeah, absolutely. So you hit on kind of the monthly goal of 2%. We break it down a little even farther to go to about 0.5% a week. That option spread is very well defined. That's the beauty of spread. So most people are familiar with covered calls. Great. You sell a call and you get some income while giving up some of the upside, and you recognize that's the trade-off. With spreads, we can define the income amount and stop giving up some of the upside after a certain point. So when you have a run in the market like we've seen since the election, and the market has been pressing to new highs, in those scenarios, you don't want to always fully cap yourself, but you want to have the income. And so the construction here of the spreads, which is where we're selling a call and then we're buying a call slightly above it using an index like the S&P or the NASDAQ or the Russell. In those scenarios, we're selling those where the time value of the option is about 0.5% a week. So if the market doesn't move, market doesn't change at all, we put that position on, we'll earn some time decay in that position. And that's it. Now, of course, if the market goes up, you'll actually lose money on the call spread, but the idea is that the rest of the portfolio will then offset it. And if the market moves up enough, the portfolio will then start to recapture some growth. So we're always out of the gate aiming to make that 0.5% a week of what I'll call time decay. It may cost us something to get out of it, but the theory with these, I'll call it an overlaying option strategy on multiple indexes and ETFs, I'll call them indexes, but they're really multiple ETF positions in individual stocks. The idea there is if you get a big run, that's fine. All you've done is given up a little bit of the upside. You still have the ability to capture more growth. So that's where the growth guy comes in. So these are set. It's actually, we run a very interesting dynamic on these. We basically, sell an option spread that aims to make 0.5% if the market's flat, or if the market runs up, it could lose 0.5%. So it's plus or minus 0.5%, and that's it. So it's very easy to define what the option portfolio is. By the way, if the market goes down, the options will still make their 0.5%. That's still the goal there, but then the underlying portfolio is also dropping. But so flat to down, options should be profitable. Up market, options will cost us. That's the give up against the underlying portfolio appreciation.
So, since you brought that up, you originally started with the Russell. The last 2 weeks, you went to the NASDAQ. And it appears that this week, or looking at it this morning, it's a very tight spread, actually, in my book. It appears that you're jumping from index to index, depending on market movement or where you think which fund is the best fit. What makes you decide which index that you're choosing?
Yeah, you're right. The first index we used, the Russell, when we first launched the fund. After the election, we took a little bit of a page out of the 2016 playbook, which was, large cap tech lagged after the election, after Trump's election, and small caps did well. Small caps are also a little bit of a proxy these days for interest rate cuts, right? You see some correlation there to interest rates with small caps. And so the move from small caps to the NASDAQ was done predominantly for, just trying to figure out, hey, where can we get a little advantage on which index will slightly underperform? We'd rather sell call spreads on the index that'll underperform the rest of the portfolio, because in that scenario, you do have a chance to win on both of those scenarios, right? The call spread makes money and the rest of the market goes up. Great. But that can also go the other way. I think the NASDAQ's hitting an all-time high today. Our spread has stopped its loss. It's maxed out its loss, which, by the way, is a little bit of the dynamic of what happens throughout the week. But in those scenarios, NASDAQ is up. The rest of the market is having a decent day as well. But you take a little bit of that, kind of alignment risk there, but it's a defined risk. So it really is more of a discretionary decision to flip to the index that we think would potentially underperform the rest of the portfolio. Even if it's up, that's okay. The idea here is that the rest of the portfolio should offset that.
Nice. And I'm assuming these are 1256 contracts?
They are. Yep, absolutely. NDX, SPX, and RUT are the underlying tickers for those indexes. The Section 1256 contracts, I'm sure some people know what they are, but maybe just a little description about those. They are essentially, it's the tax, they get special tax treatment. These are treated as commodity options, even though they're on indexes. The indexes, the options on the indexes get that what's known as 60-40 treatment, which means 60% of their gains is treated as long-term, 40 as short-term. So there is an advantage, a little tax advantage there. How that flows through to the end investor, that'll always show up on the 1099, probably one or two revisions in. We know how 1099s go at the end of the year. Probably need to wait one or two times to get the right mix, but eventually that'll all pass through and be noted on the 1099. So, if you have gains in these options, they'll get that 60-40 treatment.
Very nice. The next one I get, since we're on that subject of taxes, is the most recent comment was I worried that 97%, according to your latest 1019A, says 97% return of capital? And my answer is no, I'm not worried about it at all. Can you describe why I'm not worried about you being at 97%?
Yeah. So, but by the way, this is very common for options-based strategies. Mm-hmm. So the return of capital, look, and this is not you, of course, but I get why that classification is there. It's not really accurate for us, right? I mean, correct. Historically, return of capital was considered, a fund is just giving you back your money because, it lost money and still wanted to pay a dividend. In our scenario with options, the return of capital is based on realized gains. It means closed out positions, and we're weekly closing out the options. So if the options are losing money and we're still paying a dividend, that ends up getting categorized as return of capital. Well, as we said before, if those call spreads are losing money The idea is the rest of the portfolio should be going up. It should be appreciating, but we haven't realized those gains because we haven't closed any of the longer positions. Like when you hold stock and you hold ETFs, you're not forced to sell those. Options have an expiration, and so they will realize their gains or losses, in our case, every week. So actually, it's not a bad thing because it means the underlying portfolio should be going up at the same time. Also, it's a little bit of a break. And again, everybody, consult your own tax professional here, but it's a little bit of a break because you don't have to pay taxes on the distributions when they're return of capital, generally speaking. So it's one of those things that I actually think it's a benefit. You're getting the distribution. It's not getting taxed. Your underlying portfolio has appreciation. Yes, the options lost money. Yes, we still paid a distribution, but would you rather the alternative where the options made the money and we're distributing, but the rest of the portfolio is down? I like the first, where the market's up and I'm getting a distribution and I get a little tax advantage.
Correct. And that's my point of view also. Yeah. Return of capital, correct return of capital or good return of capital is beneficial, especially if you're using a taxable account.
Yeah, that's right. Yeah, I was just going to add to that. In a world where the underlying positions are up 24% for the year, for example, but we distributed 24%, right? There's a good chance that the same thing, majority of that distribution, like Jay said, would all be tax free or return of capital. So again, you get a reduction in basis, but it really is from a tax standpoint. It really, if you're using this if you're retired and you're using this as a source of income for retirement, I mean, whether if you're in a lower tax bracket at the time, but if you're in a higher income tax bracket and you're generating, and we have some investors say, David, I'm generating a sizable amount of income off this fund. It is a great place because it also doesn't push up your other. If you're taking money out of an IRA, again, if this is in a non-qualified account, your Social Security may potentially be taxed less, but you're still getting the income. So I really do think don't let the return of capital scare you. Ultimately, in the short term, it's a great thing from a tax standpoint.
That's right. And everybody should seek their tax advisor. Yeah. I have my own tax advisor, right? Because, ROC is actually just a deferred of taxes, just in case when you do sell the shares, your cost basis has went down, depending. And that's, again, consult your tax advisor.
Yeah, so this is a great example of when we were building this out initially. Here's just an example of some of the funds that we can own. So I mentioned this earlier, right? So you get SPY, which we all know, S&P 500, broad base. But then if you look to the right, some of the more unique ones, if anyone has followed the Freedom Fund, emerging markets, I'll tell you, here's my view on emerging markets. China, in a lot of these emerging markets funds, China was such a large allocation of these emerging market funds. And I just, again, I have to separate out. We can make a profit in a lot of different ways. I just felt very strongly that I don't want to make a profit on companies that have a high percentage of state ownership, right? So a lot of these Chinese companies, look, there's some great ones, but the challenge is finding companies in emerging markets that had very little to no state ownership. Emerging markets, that's the whole theme of the fund. Now, again, it's not a large part of the portfolio. We've reduced some of the exposure there to go into individual countries. But you can see intentionally, and that may have hurt us a month ago when China did really well, but you'll see intentionally we've stayed away from China. And me and Jay have talked about this. Just because we don't directly own Chinese companies, we still have exposure to China, right? The S&P 500, if you look at where a lot of their earnings are coming from, you get exposure from China. Mm-hmm. If you look at the NASDAQ, it's a similar thing. So I would rather, if a U.S. company is doing business in China, that's fine. But we have steered away from direct state ownership in the fund. So again, if you're looking to own international companies and you want to own it in a way that if that's something that's important to you, then a fund like GIAX could actually check that box for you, which I think is great. And then we've moved some of these positions around a little bit. We have shifted post-election. So, and I can talk about this high level, but
to ask, how do you reconstitute and how do you rebalance?
Yeah,
at different times.
Yeah. So it's a good question. So again, we're not an algorithm driven rebalance, meaning a lot of these funds too, they have this algorithm that what the computer says they do. You're getting old fashioned institutional, value investing of looking for companies that we feel and sectors and indexes. We're looking at the macro, but we're also looking down at the company level investing. So again, what was a catalyst that shifted? So after the election, there was a real push that we felt small caps and mid caps should outperform long term, which is why we switched from the Russell, which we talked about earlier. But you can also see we did add a position in there, VOT, I believe is the ticker, which is the Vanguard mid cap strategy. So we reduced, one of the things that we did, we actually reduced emerging markets. I am still bullish on emerging markets, but we felt at least over the next few quarters, U.S. mid caps, we'll see, could be the big performer post election. A lot of that we've already seen. If you look at the return, I meant to pull it up, but if you compare mid caps to large caps post election, they have outperformed. And so we just felt that was a shift that made sense. It's currently paid off for the portfolio. But there's a lot of upside still for international. And I think some of that's going to be the dollar. We've had a strong dollar. If you've tracked the dollar, that has hurt emerging markets. The U.S. has been the place to invest. It's been the place to be. But as we look across the globe, which nations are really hit and impact more significantly by rate cuts? So if you follow Europe at all, if you looked at the last time we had a rate cutting cycle, European companies are very sensitive to rate cuts. And so this is why as European central banks cut rate, you're probably going to see more exposure, which is why we added a company out of the Netherlands, which is ADYY, great company. They are a Dutch payments processor. But there's going to be certain sectors of companies that could even respond even more favorably to rate cuts than even here at home in the U.S. So Europe's a country that certainly are going to see the positive benefit of that. But also as the U.S., the forecasts are still for at least 2 rate cuts next year. I'm hoping for a softer dollar. I would say a softer dollar is going to lift all tides, right? It's better for U.S. companies, but it's also going to give some of these emerging companies, European companies, a fighting chance. So right now we are, I think the numbers are around 85% domestic. We have been much lower than that when we started the fund, but you will see some of that exposure increase to Europe and Asia, depending on where rates go and depending where the dollar goes.
Very good. And I noticed that you own individual stocks in there, and it doesn't seem that you're rebalancing. It looks like you're letting them run when they're on a run, which is what I prefer. If something's going up, why are you going to rebalance?
Yeah. Unless the theme has changed again, like we're not going to be emotionally swayed because the stock price is down for a quarter or even 2. So I like you're either. I'm not telling you something you don't know, but you're either a trader or you're an investor. And so we're not like some of these other funds that are going to be in and out of these positions monthly because again, technical analysis changed or algorithms changed. There is technical analysis, especially on the options piece that we look at. But as far as the individual holdings, we're investors, meaning if we are buying a company, we believe in the merit of that company, but it's also, we're not just looking for the next quarter. I mean, some of these names, this could be a 3-year outlook that we feel that we will be in this name until we fully realize its profit potential. So again, you're getting some old-fashioned, old-school, true investing of holding companies that we think are going to be a good fit long-term for the fund.
Yeah, and my personal portfolio, besides my speculation side, I hold funds that hold the underlying. Is my theme that I go with. So because you actually hold either an ETF or something like, a fund or a direct stock, you're actually holding that underlying, meaning you're actually investing in those companies or underlyings.
Yeah, that's right. And again, a little bit of a macro. If you followed Argentina at all with the new president that they have, Argentina is facing a lot of issues. They have a new president in there. You may love him, you may hate him, but the economics speaks for itself. I mean, if you look at ARGT, since we added that to the portfolio, I mean, the fund's up 55% plus. Post-election, Argentina's up close to 40%. So, example, again, it's not an overweight of the portfolio, but it's hopefully showing investors that we're looking at these areas. We're watching the macro issues down to the singular unit, the country, and then the company level of companies that we're adding to the portfolio.
Since we're talking about that, can you give me your view on PKX and why you're looking at that particular fund? I mean, it's down, but it could easily be because they're going to do something that I didn't know about, because it's a new company for me.
Yeah, you have to bring that one up, right? The one that's down a little bit. No, it is down. Again, it goes back to so they had a rough quarter, and so rightly so, the stock sold off. I would have loved to be buyers of that today, but we've owned it and we still own it for the reasons. I mean, but there were some good things in that report, right? Like net income still up close to 5% year over year. The sales revenue is up 5%. So again, this is a steel manufacturer out of Korea. They've gotten hurt with the dollar. It's a strong dollar. So I do think they've got a lot of tailwinds going into next year. They also have a battery material section that's gaining growth as well. So again, this is one of those names where I know that today, if you've been an owner of the stock from the start of this year till now, probably not very happy. But if you're looking to buy our fund now today, GIX, you're getting in, I think, on a name that has the potential for some very nice upside that I actually think will be a big catalyst, a big push for the fund. But we review it. If we get through another few quarters, the situation doesn't seem to change. Obviously, we'll make changes accordingly. But I have zero concern about this company. Actually, I'm very excited about the future of it.
Sure. It looks like they're doing lithium processing and stuff like that in the fund or in that company. So
that's right.
That's an up and coming, for lithium batteries. If anybody's been following that market.
Yeah, that's right. Yeah, but it's nickel, cobalt, aluminum, all the things that go into making those lithium batteries.
Yeah, thanks. So we went through a handful of these talking points already, but the idea here is selling more frequently should earn more premium over time, right? So selling a 1 month option for one time or selling 4 times throughout the month, the idea is you should be able to harvest more premium because options have their maximum amount of time decay right as they approach expiration. And so we like to sell as frequently as we can. We're not quite daily on this fund yet, but it's something that you always have the conversations about these things. I think for this as just as the additive or the driver of the income for the funds, really the driver of the yield that we distribute just comes from selling these selling the options more frequently. And that's what that graphic on the right there shows, that if you're going to have a time decay of 3 options versus 1 option, you can earn that theta more often by going in a shorter time period. And again, I think we talked about we're selling slightly out of the money options, right? Around 1% out of the money. So you still get a little bit of lift from the first click of appreciation of the portfolio, and then selling and then buying the option above it. Right now we're a little tighter than what this says, because as you observed, tighter spreads are always a little better because they stop giving up the upside sooner, right? So I'd rather the cap be a shorter amount, a lower amount, than to be giving up the upside for too long. So that's kind of the underlying thesis behind selling the credit spreads.
Correct. And I just brought it up from my point of view is the underlyings are up 0.77 according to Seeking Alpha, and your actual is almost up 1%.
Yeah. So today, well, here's the thing: the options have kind of maxed their loss, right?
Yes.
So we hit our cap last week on that particular position. We'll roll into new ones today. I always love selling, calls when the market's pressing new highs. That's always a great thing. We will reestablish a position today. So right now you're just seeing the kind of uncappedness. Is that a thing? The fact that the portfolio is uncapped.
It's something I understand.
Yeah, the uncappedness. Max uncappedness. I don't even know if that's a thing. So we'll so the upside is really reflecting the portfolio appreciation and some of the stronger holdings in there, doing a little better than the market. But, I think when it comes to this, we always want to compare to, some kind of a benchmark, but it is more of the mix than just the growth piece, right? So we always like to keep a handle on comparing to, other potential allocations that have the growth and income part. But as David said in the beginning of the of the discussion, not a lot of those have international exposure besides what the U.S. stocks already have. So it's yes, we're selling calls on U.S. indexes. By the way, we could move to international, right? There are a handful of developed and emerging market indexes. Their liquidity isn't as great, but I would not be surprised at some point you start to see a mix here that aligns a little closer to the underlying long stocks that we hold.
And Brett, I was just going to add a piece to that is, when I'm looking at this because we see this from our private wealth practice of individuals that have come in, they're in retirement, they need income. And this is where I would always say, like, diversification is key. Normally with a lot of these covered call funds is that one fund it's not very diversified. So you always have to ask yourself, how much of my portfolio can this one fund be? And of course, again, I'm the fund manager telling you, but we do feel like this fund can actually have a larger piece of the portfolio, mainly because of the underlying diversification, because you really are getting. So like we've had clients that have come to us and said, hey, I'm a little short on income monthly. And when I think about it, a 20% allocation to a fund like GIX, that bumps the entire average yield up on the portfolio by 5%. So again, I know, Brad, you've got your certain metrics that you're looking for, levels that you want to hit on your income. But I do think a fund like this can really do a lot to make a difference in monthly income. And you may say, well, David, I'm nervous because I don't know how much to allocate to it. But if you have equity risk, that's your risk tolerance for the piece of your portfolio that you're willing to take on equity risk. To me, it's you want to get the best yield that you can get. You want to preserve the NAV as much as possible, but also you want to be able to confidently know that when you're spending that money that's coming in, if you're using it for income, that you're going to be able to depend on that income long term and that your NAV's not going to be eroded. So that's really where I feel it can have a bigger piece of the portfolio given the diversification and given the amount of yield that we're kicking off.
And I don't want to give financial advice, but I like all three. I like long calls, I like the call spreads, and I like zero DTE. So I have funds that have all three, because when does one beat the other? Right? But I like your, in this particular, doing the spreads, you're my fund, right? I don't have a secondary fund, or I'm not doing one on the Qs or the SPY. I went to yours because of the diversification.
Awesome.
All right. So that's why I like it, because now I don't have to own other funds to get that diversification.
Yeah.
So if I was going to do the long calls, I own three different funds, one on the Russell, one on SPY or the S&P 500, and one on the NASDAQ 100. All right. So that's how I look at it. That I don't need that because this is an all-inclusive fund.
Yeah. That's great. Yeah. How do you get alpha? Right. And I always think if I look into the next few quarters, this is where I think like good old picking the right names. When the indexes were going straight up, you wanted to own the indexes, right? If I can't beat them, just join them. But I think we're going into a period where it's going to actually pay off to pick the right underlying names. Meaning, I do think we could get some divergence on, when you're at 23 times forward for the S&P, this is not a cheap market. When markets are cheap, I say close your eyes and buy the indexes. You get into 23 times earnings. I think you'll be rewarded by being very selective on the areas that you own, the indices you own, the sectors, and also the regions that you own as well. Which is why, again, I do feel like it excites me about this fund, Brad.
So on this slide, I noticed that you said 20%. Is it the goal really 20% or 24%? And will there be any changes that we have to think about, or is the option still giving up that 0.5% a week?
Yeah. I mean, even if you do the math on that, right, we're even a little higher than that 24%. But I would say this, like, look, I'd rather do a little under promise and over deliver and give ourselves some flexibility here. For me, when I think about the yield, right, just having a very set amount defined every day makes it very easy to keep track of what's happening there. So, for example, the NDX spread that we have on today, it's a 50 wide spread, right? We sell that, we make $25 on a 50 wide. That's where we're kind of in this kind of 50-50 range. Regardless of what happens, we're going to earn that $25 right now. The market can go up a little bit, and that spread will cost us more than the 25 to get out, but we already talked about the corresponding offset within the portfolio. But regardless, that $25 that we sell the $50 spread for is the piece that we keep track of when we aggregate how much we're going to turn around and distribute. If we decided, hey, you know what, let's sell a little farther out of the money, let's capture more upside first before the call spread kicks in, then we would have to lower the distribution a little bit. But for now, I mean, I think the very minor, changes to the spread strike selected. And when you'll watch when we put a new one on, usually these are Monday to Mondays. We like to capture that weekend, that last bit of weekend expiration. In those scenarios, so far you haven't seen much change from us in the amount of premium we're capturing on the entry. But you could always look at that and see if there's anything that's new there. I don't expect any change in the near future unless we decided that people didn't want as much in the distribution, and then you might see us come down closer to this 20. But that's right now. It's our target is to be 20 or more.
Very good. Any thought about the indexes are right now at the lowest volatility that I've seen in a while? Any thought about that?
It's also that's an important point here when it comes to selling options. It's the implied volatility that drives that premium. In that example I just gave you, that $25 is easier to get when you have a higher volatility index like the Russell or the NASDAQ. It's a little harder to do on the S&P, which is why we give ourselves a little flexibility. You can't always get kind of that 50-50. The 50-50 just happens to be a convenience for us. It's not, there's nothing in the prospectus or nothing in this that says we're going to do that when it comes to the options, but it makes it nice and easy, we think, for investors who are watching, as you are, to look, okay, where, if I know how wide that spread is, I could do the math on how much that GIAX made for me that particular week. So it's meant to be a little bit of a hack if you want to figure out how much we're really selling for just by looking at the width of the option spread. By the way, it doesn't matter which index you're doing it on, because if you can always get that 50-50, then you always want to choose the one that has a tendency to go lower, but you don't always get that choice, right? So you'd rather pick the one that you think is going to underperform a little bit. It's something we review. You saw, or I mentioned before, we changed after the election. It's not something we're ultra active on and changing every week, but it's absolutely something that we review in our investment committee meetings. We may change again.
That's right. And I'm perfectly fine with you writing on any index, because where do I care where the money comes from?
Right.
And this is your team. So let's talk about your team real quick. So Jay, you do the option side with your team. And David, you have a team of advisors looking at different either stocks, indexes, and stuff like that. So one question I always have to ask is, what is the goal of Nichols Wealth? How many people do you have? It looks like you have other funds, and it looks like they have good assets under management, which is good because that tells me you're not going out of business next week. Right?
That's right.
I mean, those are important to investors, right?
Yeah.
And that's something that people need to look at, because I actually have looked at FIAX, and maybe we'll talk about that at a different date.
Yeah.
So
no, it's great. So yeah, we're a private wealth firm, and I've known Jay for probably 12, 13 years now, and so I've seen Jay has always been someone that is such in our space, in our industry, such a leader. His team is so good at what they do. So when we were looking for an options portfolio manager, the answer was clear. Like we wanted to work with Jay, we want to work with Zega just because of their track record. And so, our team though on the equity side is we have an investment committee here separate from the fund that looks really at our equity allocation. So we have SMA strategies that we manage here in house. We have a team of about 18 here at Nichols Wealth. And so again, it's bringing our two specialties together. Obviously with Jay and I've personally traded options for over 15 years, but again, we still wanted to partner with a firm that we felt had the not only the front end knowledge, but just the back end expertise, right? So there's a lot that goes into trading these options. There's a lot that goes into just the analysis behind it. So we felt very strongly with Jay and his team. And yeah, for Nicholas Wealth, this is our second fund. We have a few other funds that we're going to be launching as well. And our first fund was FIX, was our fixed income fund. I love that fund too. I know it's boring compared to this, and maybe we have some time in the future to talk about that. But that's your treasury, 98% U.S. treasuries with an 8% yield. It wasn't that long ago that was a pretty shocking thing to have, right? 8% yield and 98% treasuries. So it's a fund that we've seen a lot of great successes. We've had other countries, sovereign nations, put their pension funds into FIX. So there's a lot of excitement there as well, but different risk class, obviously a lower income, where GIAX really checks that box for high income with growth as well.
And that's right. And I look at correlation, since it's, treasuries, they're not really correlated to equities.
Yeah.
I also look at CLOs, because the CLOs are not directly correlated to equities. It's about a 44% correlation when you look at those.
That's right.
So I look at correlations in my portfolio, and I always, again, that's what drives me to you for the diversification.
Yeah. Well, if anyone's owning bonds, again, we benchmark to the AGG. FIX is outperforming AGG. Give me the time period, and you will see we're outperforming year to date. We last time as of a week, outperforming month to date, outperforming 1 year, outperforming since inception. So again, if you're going to own bonds, it's worth considering a look at as well.
And here's all that legal stuff.
Right.
Please pause the screen now and read all the legal.
I think you got to leave that up for exactly 13 and a half seconds. Right?
Oh, is that exactly what it is?
Yeah.
I did not realize that there is a legal requirement there. Thank you.
My team can tell you, because we're saying you guys got to keep it up longer. So I think we've had it up there, I think, for a decent amount of time. So that's good. Good.
And it's important. Everybody, and what I'll end up doing for the viewers of the video is I will leave a link in the pinned comment and in the description to their website, because everybody should go read all the information that they have available to make their own financial decisions, or direct their financial advisors to these guys so the financial advisors can do that for them. So anything you'd like to add? Anything you think the market's headed? Not forward guidance or anything. Do you think the market's headed up? Market's headed down?
Well, I was going to add, just you asked about up markets, or is the market up or down next year? Again, there's a lot of optimism, but I got this question from an advisor the other day. Hey, David, how does GIAX perform in a down market? And I actually thought it's a good question, because we have clients that ask us about buffer ETFs, and hey, David, I want income, but I also don't want to be down 40 or 50%. But I'll tell you what's interesting about a fund that has an option overlay like this is the fund does not use leverage, right? So this is not a 2x leverage fund. It's not a 1.5x leverage fund. It's taking on the traditional equity risk like you would in an diversified equity portfolio. But remember, a call spread strategy is a neutral or bearish strategy. So if we go into a down market, again, no guarantee, but because of the weekly income that we're generating on the fund, we should have some outperformance relative to those indexes of the underlying, mainly because of the income that we're receiving from the fund. So again, it may not be 1-to-1. If the market's down 24, are we going to be flat? Well, it all depends on how the market did. But I actually think there's a lot of confidence in if we're in a down market, the fund could actually provide a pretty good buffer. Not because it's a buffer ETF, because the income acts like a buffer. Jay, I don't know if you want to add anything to that at all, but
no, absolutely right. It's from a return perspective, and the benefits of selling those calls and call spreads, they should be constructive to the performance of the fund. And the argument there is that you end up losing less than the indexes and the underlying build that you have in the portfolio. we would, again, stick with selling what we think will be the underperformer of the indexes, but it's for sure designed to give yourself a little bit of an offset. You're right. I wouldn't use the term buffer, but we will have, positive returns from the option section of the portfolio in a down market. But it all depends how the down market comes. But one of the criticisms that you always get on a covered call strategy, and this happens when you're only selling calls, like a lot of the, funds that have been around a long, long time, right? If you look at, Global X's or JP Morgan's funds, those typically get what I call whipsawed, where the market drops, selling calls on the way down, and now they've capped themselves at a lower amount where they were before. For me, I like the spread approach that I don't worry about having the time like, oh my gosh, market's down too much, don't sell that call because if it rebounds, we'll get capped. I don't mind, because of the call spread dynamic, that we could be really regimented and disciplined about generating the income on the way down. Because when you do get, even if you get like a snap bounce, we saw after the pandemic, or we saw in 2018, where the market reversed very, very quickly, you're going to find yourself participating right back on the upside. So we in those scenarios could arguably have higher income than the 24%, because volatility will be up as well. So maybe you sell for more income to offset some of the decline. And because of the call spread tactic, I'm not worried about the snap rebounds and getting stuck way underwater, which a lot of funds, have that challenge.
That's a great point.
Sure. And I've looked at, some put spread collars, a particular fund that does that, and their protective puts are 5%. So the market has to drop 5% in a month for them to actually start to kick in. And I'm like, why am I going to give up approximately 5% in distributions to put those puts that may or may not ever kick in?
Yeah, and you're talking about hedges using options, right, as protection for, offsetting downside exposure. In this case, you've got, and you're right, and those will cost you over time. So that is a, we'll say your long time decay in that scenario, which decay is bad. Here we're short time decay, which is good in that scenario where we're earning it. So, two sides of the same coin. Just, want to see which side you feel like being on. Over time, as you said, stocks generally tend to go up and to the right. This one will participate, GIAX will continue to participate in those scenarios and not have a drag of a hedge, which, we've got a lot of experience, and so that's okay for some people. But in this case, we wanted the growth and the income. Those are the investments. That's really the investment strategy this fund focuses on.
Any Christmas surprises and distributions that you may or may not be able to talk about? You can wink once or twice.
Because I'm sure that's totally fine.
I'm gonna wear sunglasses for this question.
Yeah.
Oh gosh.
I'll make one comment, right? The fact that such a high percentage of the fund is return to capital generally means you shouldn't expect any like end of year forced distribution.
Correct. And when I look at it was just a question that somebody asked, and I thought I would ask it. And I look at this as, if you're managing it correctly throughout the months, there isn't very much left over to distribute.
Yeah, that's right.
And you guys appear to be doing a very good job. So thank you.
Thanks.
Anything else you guys like to talk about? We'll open it up to.
I think we covered a lot, and I think it's. I appreciate Brad, you highlighting the fun, and again, if anyone has questions, I'm open, and I know Jay is as well. But anyone can reach out to us. So email us. You can call the office. I'm here. Advisors are here to answer any questions that you have about the fund, and so we're grateful to talk about it and happy to share with as much as we can.
Well, thank you guys. Thank you for coming on.
Thank you for having us.
Absolutely. Thanks for having us.